I have the enormous pleasure of introducing Dr. Jackie Meyer. Jackie talked a lot about our relationship. Anytime that you partner in a business, it's very much like a marriage, right? With your business partner, you have to go through the good times, the bad times, all the ups and downs, everything that can happen, right? And when you find a great partner, you really want to find somebody that has kind of the complementary side to you and vice versa, right? That's what you're after. And when I met Jackie and spent the first few hours with her that I did when I started working with TaxPlanIQ, I knew right away that we had that perfect balance and complement of each other, kind of that yin and yang to balance each other and really make ourselves better together. And so I'm really excited, for this because I couldn't introduce a better, more, dedicated, loving person in this industry who just really wants to make your life better. She's been there, right? I shared her story, right? So, but if you don't know her, she's an award-winning entrepreneur. She's the visionary founder, obviously president of TaxPlanIQ. She is a trailblazer in the accounting world. She's earned national recognition as the CPA practice advisor, 40 under 40 honoree, 5 consecutive years. She's a highly sought after keynote speaker, delivering, very powerful practical solutions that elevate tax and financial literacy, driving that talent retention, integrating cutting edge AI across accounting firms. Beyond that, right? She's got multiple successful ventures, but she's also finished. She just finished it and it's coming out. She wrote a book called The Balance Sheet of Life. It's really a bold exploration of personal and professional growth. She's the creator of the ROI method, which we talked about a little bit ago. She'll share more on that as she goes today. And each year, Jackie inspires and educates tens of thousands of financial professionals and entrepreneurs, equipping them with really the transformative tools to thrive in their business. So her mission's clear and powerful. It's to help you improve your health, wealth, and relationships, and ultimately really lead more fulfilling lives. So I could not be more honored to introduce to you, ladies and gentlemen, Dr. Jackie Meyer. Jackie, the floor is yours.
Thank you so much, Dave. You made me cry. All right, let's get this going. I'm just going to share my entire screen with you for a couple minutes because I'm going to be hopping around in TaxPlanIQ. Oh, what a day so far. How are y'all feeling out there? Good? See some reactions. Hopefully grabbing something to eat, meal bar, whatever you need. Yes, love it. Okay, Dave did a lot of the hard work for me by showing some of the new features, enhancements, and oh boy, there goes my dog. Hold on. Sorry, one sec. Real life, right? 3 dogs. Oh, that's my next slide, actually. Here you go, guys. 3 dogs, 2 cats going on over here in South Lake, Texas. This is me. If you want to connect directly with me, you can scan this code on Popple. And I believe it actually lets you WhatsApp with me or text with me or anything that you need. On LinkedIn, I have a pretty strong presence these days, so I would love to connect with you there as well. But we're going to go over the 3 perfect tax planning clients today. And then Angie is going to actually go over like 7 perfect strategies later. And so it's all going to come together in this beautiful wrapper for you today of how to do amazing tax planning for your clients. So our agenda for this session, this is a 1-hour session. So we'll end at noon Central Standard Time, maybe a little before if I can give y'all a break. We're going to kick off with defining and automating tax planning. I'm going to show you an example of another 1040 upload into TaxPlanIQ, real world example of how quickly within just 3 minutes you can now create tax plans. Then I'll actually go manually through 3 different avatars or client profiles with you to show you how to identify kind of 5 perfect strategies for different types of profiles of clients. And no, it's not just high net wealth. And then we'll wrap up with, Dave alluded to this, but there's some pretty special stuff going on with our value pricing calculator and a big mass release that's happening with the AICPA very soon. So let's start with defining tax planning. This is one of my, the things that really bothers me on a day-to-day basis. It's hard to sleep at night sometimes because we don't have good definitions of these things in our profession. A tax projection is just telling you what you're going to owe. It's not actually planning, right? And so when I go to conferences and see people and talk to thousands of accountants out there, I'm like, hey, do you do tax planning? Yeah. Well, I kind of have to deep dive into that with people to know if they're truly doing tax advisory services or not, right? And so we need better definitions. But for today, know that a projection is just saying, oh, you're going to owe 50K this year. Planning is when you're going to say, oh, you'll owe 50K, but it looks like we can reduce it by 30, or you can reduce it by 30. Tax strategies and full advisory work is where you're implementing that plan to reduce the taxes by the 30K. That's what everyone wants. That's your highest net profit margin by far. And so that's what we want you to do with TaxPlanIQ. So Dave showed you the wrap process where we automatically read, redact, analyze, and propose tax strategies in TaxPlanIQ. It's really cool. During the spring, when y'all were all heads down in tax prep, we were perfecting the process into like 60-second load, process, plan production in literally 3 minutes. So I'm really, really proud of that for my entire team at TaxPlanIQ. It's very revolutionary. But we also have embedded in the system this ROI method of value pricing and the CURB framework. So how does that work? Well, Dave showed it briefly. I'll show you again. We take the financial savings or gains that you can estimate for a client. Let's say that's $100,000 of tax savings for the client, right? And then you apply CURB. How complex is this work for you? How risky or urgent is it? And what kind of intangible benefits can you bring to the table for the client? And based on whether those are high, low, or medium, you essentially apply a percentage to that tax savings to give them a value-based price upfront. It is
Hey,
not
hey,
a contingent fee on the back end by any means.
Jackie, I don't want to interrupt your flow, but I don't know if you know this, but you've got the slide version up. You're not full screen with your slides.
I do, yeah. I did
Okay,
that on
all right.
purpose because I'm about to
Okay.
hop over to Tax When
All
IQ, and then
right. So
I'll go full
just letting
flow.
everybody
Thank you.
know. That's okay. Good.
Yeah, yeah. This is on purpose, you guys. Just hang tight. Okay. So in our CURB tiers, we've got a sample stack here. So if everything is low for the CURB profile, your fee is going to be much lower, right? Maybe 10, 15%. A sample of that could be you working with their financial advisor to do a backdoor Roth. You're not super involved. Maybe also working with that financial advisor to do some tax loss harvesting. A medium tier, and this is all subjective, right? So that's why you get to pick low, medium, or high. Maybe S Corp, reasonable comp, Augusta rule, accountable plan. There's some things that you have to really manage and be in the details of there to make sure that they're doing it right. That might be a fee of 20, 25%. So on 100K of tax savings, you're looking at around a $20,000 to $25,000 fee. And then when all of our factors are high, you're looking at a 30, maybe even sometimes 40% fee, depending on the client or the firm and complexity. Maybe you're doing cost segs, a LERP, real estate professional, all kinds of more complex stuff. So let's look at our example here, and then we'll hop back into our avatars. So Dave showed you in TaxPlanIQ how to upload that 1040. Just to save you the 60 seconds, since we're going so fast today, I already loaded a return. It's actually this one right here. It's redacted. Nothing looks too special here, right? We've got like 200K of W-2 wages. We've got a little bit of interest income, dividend income, IRA distributions, and a bit of a capital gain. And so TaxPlanIQ, within about 60 seconds, produced these suggested strategies for me. So based on the fact that we had the IRA taxable distribution of $42,286, it's saying, hey, there's an opportunity for retiree planning here. Okay, cool. Yeah, let's add that to our plan. This client did have capital gain income, and they had enough taxable income to where they may be able to do a solar investment, alternative investment strategy. So it's suggesting that. We'll add that to the plan for now. We'll talk, of course, to the client or add a task here if we want to talk to them about how aggressive or conservative they want to be with their planning and how much cash flow they have available. Hiring kids, they had 2 dependents on that 1040 that qualify for the child tax credit. They have a small Schedule C on this return. And so it's suggesting that we go ahead and pay them each maybe the max 15K standard deduction. Let's change this down to like 15K total because maybe they can't justify the full standard deduction amount. Pre-tax benefits. So on that 200K of wages, very simple stuff here, y'all. But so many accountants, advisors are not doing this. Just helping them look at their pre-tax benefit package, maximize 401K contributions, etc. 529 savings plan. So this is really standardizing the process of things that are going to be really hard for us to remember to do on our own. I did this manually. I would go line by line through that 1040 myself, and I would pull together these strategies, and then I'd pull together the tax savings estimate, and then I'd show them that ROI based price in Excel, right? But now we've got this standardization to where we've got over 50 strategies being auto suggested to you from that 1040. And then within the next quarter or two, we already have a client questionnaire, but it's actually going to be mass customized with AI to actually help you identify the rest of the strategies that are in our library, which is over 130 and growing. So we've covered all of our bases here. Let's add our strategies and review them. Zoom is acting a little kooky with our ROI. Okay, perfect. So it worked out fine. So we're estimating that we've got 53K of tax savings for the client here in year 1 and 53K moving forward year 2 as well. So here's where we pick our CURB. Well, these were all pretty straightforward things, right? So I'm going to pick low on all of my offerings here for CURB. And it's suggesting that I charge a one-time implementation fee of $12,748. Well, for a lot of us, show the reactions if possible. That's $12,748 more than what you were charging before for this work, right? Pretty amazing, right? And the client will pay it in a second based on the visualization that you're going to show them and how you can help them. So we'll go ahead and add that fee. We could also add an ongoing monthly fee for future work too. We didn't create any tasks, so let's create our plan. And let's take a look at our results. So we've got all those things that we just added. We've got our return on investment proposal summary, the 58K of ongoing savings, the 12K fee, the 503% immediate ROI, over $500,000 of tax savings in the next 10 years. The clients will look at this and literally sell themselves. Like, why would I not do this, right? Because that 12K is probably a third of what they'd have to make in estimated tax payments anyways, right? So it's just so win-win, and you can be such a return on investment for your clients. You've got our full PowerPoint presentation report. The what you keep is really what I think helps people understand this so much easier. And then that full tax plan report. So people were asking earlier, how do I charge for this? Well, I wouldn't just give away the report. I would show them the proposal. I wouldn't show them the strategy level if they haven't paid you anything yet. And I would say, hey, look, here's what I can do. Here's what I charge. Do you want to move forward? I do have some users that will go ahead and charge a flat 1 to 2K tax plan fee to give them the report, and then actually upsell the client into an implementation package or ongoing monthly advisory package as well. So there's a lot of ways to do it. Our growth sessions deep dive into all of the ins and outs of this as well. All right, so that's example number 1. Now let's go deep dive into 3 different client avatars. So I'm gonna stop sharing for 1 sec. I'll pause here. If there's any Q&A that I really need to address, team, just let me know. And if not, then we're gonna hop back into our slides here. All right, resharing now. Okay, avatar 1, or client customer number 1, or ideal client customer. What is that called? IDC, right? So we've got a solopreneur, small business owner, transitioning to an S corp. Sounds pretty straightforward, right? You probably do this all the time. But are you actually managing the entire process for them and making sure that that S corp was really the best decision? Because sometimes it's not, especially with QBI involved these days. So, our client overview, they operate as a Schedule C sole proprietor. They earn more than 100K annually, netting on that Schedule C. They're looking for tax saving opportunities. Oh, and guess what? They saw on TikTok they should be an S corp for added benefits, right? So, they have few or no employees. They wear multiple hats in their business. So, what do we do here? Well, strategy number one, entity analysis. Now, I gave y'all exactly how I would do this in like 30 seconds for a client proposal instead of a full on detailed analysis after they pay you to implement this plan. Okay. We're working on estimates up front. You value price up front. Let's say you do this with one client. You pitch a 10K fee to one existing client. That covers 2 months of one of your team's payroll or a new team member on your payroll, right? That's giving you the cash flow up front so that you can invest your time in this new advisory work for this one client and delegate the rest of the work to your team. Another thing you can do, we were talking about in this chat earlier, I sold 60% of my clients. They were not high revenue clients. They were not good fit clients, right? So it was only like 75K worth of work. But if you sell those clients, you get 100% of their annual revenue up front or up to 1.5 or more now with PE involved, right? Private equity. So you could sell the clients that are not a good fit and get that big cash flow payout up front and then go one by one through your client list or bulk upload all your 1040s now. And did y'all see that column that showed you the potential deductions? And that's going to get even better, y'all, in TaxPlanIQ. It's going to show you, hey, this is the client with the most savings. You need to work on this client. So when we have a profitable Schedule C that's netting 75K plus, they could be a good candidate for an S corp. But how I estimate this on my proposal so that I'm not doing too much work up front for a client or prospect is I just take half of whatever their SE tax was on the 1040. So let's say that was 15, 16K. I would use 5 or 6K as an estimate of tax savings by doing entity analysis. Does that make sense to everybody? You do not need to deep dive into the details. I hate seeing y'all do that when you haven't been paid anything yet. This should be really quick upfront proposal stuff. And then after the fact, you can do the full analysis and whatnot and make sure that it's the right fit. So in this case, the S Corp is actually a better fit for this client. They earn over 150K in net income. You verified that. Sometimes they tell you that, but it's not true. They can pay themselves a reasonable comp of about 90K. And so if you're taking their salary down and putting some of that to distributions, we know we're saving what? Self-employment tax of 15.3% on that. And that ends up being about $9,180 in this case. So we're reducing their SE tax liability while staying compliant with the IRS reasonable comp guidelines. Strategy 2, another super easy one, solo 401k contribution. So did you know that if your taxpayer is the only owner or only employee at their company besides a spouse, they can do this for them and their spouse? It's a really great trick for my high net wealth, kind of like semi-retired executives that I form small companies for. The plan does have to be established by 12/31, if not a little bit earlier, to do the 401ks. So be careful of that with the tax year. And I do not recommend doing a ton of tax plans on 12/31. I did that the first couple years that I started leading with tax advisory in my firm, and I was spent. Instead of 4/15 being my busy season, 12/31 was my busy season. So have appropriate cutoff and boundaries and deadlines with your tax planning, and you can very easily spread it across the year. And then you always have to ask the client before you even give them this proposal. There's a few preliminary questions that we have in a questionnaire in TaxPlanIQ. One of them is, how much do you have in cash flow towards retirement contributions that would potentially save you money in taxes each year? And they'll probably say, I have no idea. And you say, well, just give me a general idea. Is it 20K? Is it 5K? Is it consistent over the next few years? Because you need to work with that number and back into what strategies you suggest and how they best spend that cash flow. All righty. So looks like, oh, this is just giving us more of that situation of how they are maxing out the employee contribution of 23,000. Then they're maxing out the employer contribution, which is 25% of their wages or whatnot. And they're able to reduce their taxes by a substantial amount. Strategy 3, accountable plan reimbursement. Another very straightforward one. We do this for our corporation clients. You ask them, what out-of-pocket business costs are you currently paying personally? Mileage, home office, cell phone, internet, education, supplies, travel, etc. And will the client track this stuff, right? So home office square footage, actual home expenses each year. When I'm doing a proposal, I use a standard $5,000 as my deduction suggestion. WRAP also suggests $5,000 if it identifies someone that has a business on that 1040 return. You can adjust that up or down depending on your client's needs. So if someone says, yeah, I mean, sure, I have that, and then they actually identify 7,200, there's a proposed versus actual feature in TaxPlanIQ where every year you can revisit what really happened. So here's what we projected. Here's what really happened. And what's so cool is that the return on investment for the client tends to be higher once you get into the weeds. And strategy number 4 for this avatar is hiring your kids. It needs to be a legitimate business structure, obviously, and have documented duties and reasonable wages. Remember, fun tax tip, Schedule C or parent-owned partnership, you can exempt the kids from FICA when you pay them if they're under age 18. So don't pay that extra FICA if you don't have to. So in this example, they're paying their daughter that's 15, $6,000 a year to manage their social, which is a great thing to do that none of us want to do on our own, right? And clean the office. Taxpayer deducts the $6,000 from their business directly. Daughter pays nothing in taxes because they're well under that standard deduction and they don't even have to file their own tax return. Last strategy for Avatar 1, turning around now that kid has earned income, W-2 wages, they can contribute to a Roth. And they don't have to be the one to contribute to the Roth. It can come from any source. So the child has the earned income. They have the bona fide source here. We can contribute up to $7,000 in 2025 to a Roth IRA on their behalf. You can set up that custodial Roth IRA using their SSN. You have till April 15th after the tax year to do that, which is great. Applies retroactive, and anyone can deposit the funds. Pretty cool stuff, right? Now, how would I track tax savings on this? Dave showed this briefly, but didn't discuss it earlier. What we do is we just take a market growth rate. So if you're investing in stocks or mutual funds, et cetera, it's probably 6-8% plus annual growth rate. We do the same thing in TaxPlanIQ. So if we're suggesting a Roth in our wrap feature, or if you're adding it on your own, just use the drop down, and instead of using the client's like effective or marginal tax rate to produce estimated savings, you would use the custom market growth rate, and then it would calculate annually whatever that is on the $6,000 that this child's being paid. Okay, so how does this all look in TaxPlanIQ? Well, this particular client had an effective tax rate of 30%. We use effective rates instead of marginal to be extra conservative with our estimates. And then they had another 9.3% California state rate. So it ends up being almost 40% tax rate effective for this client. So we pull together these details: Roth, accountable plan, pre-tax benefit, hiring kids, choice of entity. And we just produced almost $40,000 of annual tax savings for this client. Imagine how many times, there's probably some hand palms going on right now, that you've done all this for a client or suggested this to a client without any fee whatsoever. And I guarantee here's what's happened, unless you did the implementation yourself, you, forgive my French, vomited this information on the client. You should do XYZ, be an S corp, blah, 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 pay your kids, set up your wages. They go try to do it on their own, which is so overwhelming because there's so many tiny tidbits to this, or they don't do anything and then nobody wins, right? So instead, you can visualize the savings to the client here, then use the ROI method to price it. This is all pretty darn low complexity, urgency, risk. But on 38,000 of tax savings, you've got almost $10,000 of a suggested implementation fee. Pretty cool, right? So you charge that up front. You do an onboarding session with the client to deep dive into each of the strategies and go for it with implementation. You become that concierge assistant to them to help them set up the kid on payroll, understand how to do a Roth, things like that. And I promise you, it really takes very little time once you've done it a few times, because it's all based on that knowledge up here, right? And the checklists and standardization we've provided in TaxPlanIQ helps immensely as well. Here's that what you keep slide. So this tends to just kind of sell itself to the client, which is great because we don't like selling. We're accountants. We're not salespeople, right? And so you don't have to be a salesperson. The ROI method sells itself. You show them these visuals. You can close the deal within just a few minutes. Just ask for the deal. Don't just be like, hey, here's what we can do. We'll talk to you in a few weeks. Be like, hey, here's what we can do. Are you ready to move forward? They'll say yes. They'll say no. They'll say maybe. Smart people tend to say yes. Where do I sign? Let's do this, right? And here's another look and feel of the presentation in TaxPlanIQ, where they're showing the savings versus their investment in us and their immediate ROI of almost 500%. That is Avatar 1, which is a very standardized, even keel client that we deal with a lot. Now, I bet there's some people asking, well, what if I've been giving this away to clients for free in the past? Well, go back and redefine your boundaries. Send a mass email. I posted this on my LinkedIn the other day, a template of an email that everyone should be sending to their clients after today and this exposure to all this amazingness that you see. And it's like, hey, we're converting our practice to lead with tax advisory, where we can bring an amazing return on investment to all of our clients. And that starts with redefining how we work with you. We can provide a complimentary proposal to you and quote you for this new work. We, in the past, unfortunately, we're just kind of giving it away for free during hourly consults or when we happen to talk to you on the phone. And that really is lose-lose for everyone involved. You don't tend to implement well, and you don't see the savings. So why don't you reply now? We'll give you our eCal and you can schedule a time to get that complimentary discovery session and proposal. Ask a few questions up front, get that proposal in front of them, and close some deals. So that's how you do it, y'all. Let's move on to Avatar 2. We got to move quick here. We've got a real estate investor. So our client owns multiple rental properties, reports income on Schedule E, often has MAGI above 200K. Their goals include deducting rental losses, minimizing SC tax, net investment income taxes, and increasing after-tax cash flow. So what are our typical strategies here? Well, real estate professional status is a big one. If they're spending over half of their time in the year towards real estate activities, and it doesn't have to be just one, it can be a consolidated group, and they're spending over 750 hours in real estate activities per year. This is per spouse, by the way. Don't try to combine the spouses to get to the 750. Then you may have someone that can qualify for real estate professional. Well, what does that do for them? Well, they might have been having these passive losses suspended every year of, in fact, $42,000 that we can unlock and let them and allow them to deduct this year. So that qualification can save them a lot of money, offsetting other ordinary income, saving about $10,500 at a 25% tax rate, and eliminating 3.8% net investment income tax. Strategy 2, a cost seg with bonus depreciation. Be careful. You don't want to offer a cost seg up to a client that's not going to be allowed to take those deductions. So if they, every now and then I see people with a net profit in their rentals, then the cost seg may still work. Or if you can move a client to a Schedule C short-term rental, the cost seg may work. But otherwise, you need to get them into that real estate professional status so they can take those losses immediately and do the cost seg. I've seen people mess this up all the time. I've had new clients come to me and say, oh, I did a cost seg last year, but I was passive. I'm like, oh, well, sorry, that got suspended forever. So it's really unfortunate when people don't put a lot of strategic thought into these things. Now, a cost seg is just accelerating individual depreciation to little items in your home. Like this $5,000 statue. No, I'm just kidding. That's not $5,000. So let's say they purchase a $1 million commercial building. The cost segregation identifies an immediate $300,000 in accelerated depreciated assets you can break out from that commercial building long haul depreciation. With 40% bonus depreciation available, let's say they deduct $120K in year one, and at a 25% tax rate, that is almost $30,000 in one-time, one-year tax savings. These are deferrals, by the way, okay? So be careful when you're working with deferrals versus permanent elimination strategies. I like to adjust my intangible benefit factor when I'm doing the pricing if I know most of my strategies are deferrals instead of permanent tax eliminations. So I would make sure that my intangible benefits are low to help me with that price point, because yeah, maybe I'm saving someone 100K, but if it's 100K of all deferrals, I'm not going to charge them $40,000, right? But if it was 100K of permanent eliminations, that deserves a much higher rate. Strategy number 3, 1031 like-kind exchange. Different states have even better benefits here, or some none at all, so be careful with that. You do have to use a qualified intermediary, so don't allow the client to move forward with something like this without hiring a qualified intermediary first. You have that 45-day identification window and 180-day closing window for the like-kind exchange. And Nathan Sosa actually will be on later to talk about Trump tax strategies. We had him and Brandon Hall on for a real estate monthly tax planning special several months ago at TaxPlanIQ. And they talked about doing a reverse like-kind exchange, which I had never heard of. That's a thing, is like, we have all of this knowledge and power, but like, we don't know what we don't know. That's why we need this community here. All right, so another real world scenario is someone maybe selling a duplex for 600K, basis of 300K. The capital gain would be 300,000. The deferred gain becomes 250. They have a little bit of boot tax on 50 grand. Our tax savings becomes the 250 times 25% effective tax rate for them. And that's, I guess they were in the probably highest capital gain rate plus a state rate to make that 62,500. Strategy 4, self-directed IRA. Now, this is pretty cool. This is something that any of our clients can do. They can form a self-directed 401k or IRA and invest in real estate as long as they're not personally involved or staying at that real estate for UBTI. Then you are in good shape here, because what it does is it moves the income and gains into a non-taxable account, and ideally a Roth IRA that you don't have to recognize the tax later, right? So let's say that you start a self-directed Roth SD IRA, you buy 150K rental in it, it earns 15K a year in rent, plus it appreciates 100K over 10 years. You've accumulated 250K in tax-free wealth. Outside an IRA, that would have been about $60,000 in taxes. I'm going to show y'all how this comes together in a minute with the savings versus pricing, etc. I did kind of a back of a napkin calculation for this particular example. Last strategy for this avatar number 2, our real estate investor, is net investment income tax. We have, oh my gosh, there's so many people that are overpaying net investment income tax. If they sell a pass through that they're a non passive participant in, they are not subject to net investment income tax, y'all. Okay. I see that overpaid all the time and I hate it. So go back, look at your clients, offer to amend their returns if you need to, because there's hundreds of thousands, if not millions, in tax savings just by fixing that one little thing because people don't understand NIIT. So when their MAGI is above 200,000 single or 250 married filing joint, we know we have that net investment income tax on passive income such as rentals or investment returns. So in this example, let's say we have 100K of rental income, 150K of W-2 income. Without the real estate professional status and going to non-passive, you'd have that 3,800 every year of net investment income tax. So with the election and the combination or stacking of these 5 strategies, the rental income becomes active and we zero out the tax on that. All right, so here's how this all comes together. These were the different strategies that we saved on. We've got 12,000 plus 30,000 plus 50,000 plus 6K and 3.8K of net investment income tax savings, totaling 101K of tax savings. Again, I did backhand napkin math here because we were going to run out of time if I showed it all to you in TaxPlanIQ or the ROI workbook, but it all adds up beautifully. And then we'll apply our ROI method of value pricing to this. What's the complexity, urgency, risk, and intangible benefits? Most of these strategies were deferrals. There were some permanent tax eliminations. So I'm going to do, lower level for my CURB rating. And this is a great visual. I just came up with this a few weeks ago to help simplify the ROI method of value pricing. So if you've seen the way I presented it in the past and now you're seeing it a little more simplified, let me know if you like it, because it seems to be a lot easier to understand. But you're saying, okay, is this a low, medium, or high complexity, low, medium, or high urgency? And then we essentially just take that percentage, right? So maybe we say this is all level 2, 20%. We charge a $20,000 fee one time. And I lied because I put 3 on all these. So medium, high complexity. Sorry, I forgot. But we've got the 30,569 that you could price this. Again, go lower, go higher, do whatever, your gut tells you is correct, but at least you have a starting point here, right? And some standardization. But based on that fee structure, you've got an over 200% return on investment estimated for the client. I never guarantee tax savings for our clients, but I can guarantee their satisfaction in our work and let them know, hey, we'll make sure that we do you right. If something happens and this falls through, if it's our fault, we're going to make it right. I mean, honestly, that rarely ever happens. I've had one client that went through bankruptcy after us pitching a very large tax plan. And so we just refunded their money and, moved on, right? But in most cases, you've got some pretty sweet work that you can work on here. All right, checking the time. We're doing okay. We're going to move on to avatar number 3. This is who everyone expects tax planning to be for, the high income investor, right? Or executive. So our client earns over 400K in, let's say, W-2 income or stock comp or business distributions each year. They're maybe an executive, investor, physician with complex tax needs. Their priorities include maximizing retirement savings, reducing NIIT, and optimizing charitable giving or estate planning, which Jennifer did an excellent job talking about earlier, right? Maybe they're kind of on the cusp of our thresholds for the estate tax, right? So here's our 1040 screenshot. And Angie will talk a lot more about this later in her session, but we're just going line by line to identify opportunities. Now, if you may be really smart and sharp and caught that this is the exact same return that I actually sent through TaxPlanIQ at the beginning of our session. So let's say that was like phase 1 of our planning. where we charged a $10,000 fee. And then now we're coming back to the client to a new phase of planning. Maybe this year they have things a little different from last year. They point out to you, hey, last year I had 200K of cap gains. I'm actually going to have 2 million of cap gains this year because I sold some stock. You sold some stock? Okay, well, let me ask you a question. What kind of stock was that? Is that a small business qualified stock? You don't even have to get in that level of detail with them, but who knows what strategy you would use with that? Less than 50 mil of assets in a C Corp sale, and you've owned that stock for 5+ years. Hopefully people are putting in the chat the answer. I'll show you in a minute. But we know we had like the IRA distributions. So that's something we probably could have fixed a long time ago to make that non-taxable with Backdoor Roth. And they're actually only taking the standard deduction each year. So let's take a look at what we're going to do here. What we're going to do is plug into TaxPlanIQ or an Excel workbook of the ROI method, which is what I've been developing one-on-one with the AICPA. And I will actually show you a sneak peek of that exact workbook today. We're going to take total tax paid, $62,419, over the client's taxable income, which is a $377,451. That gets us to our effective tax rate federally, right? And then we move on to the state rate as well. So let me show you what that looks like here. This is our sneak peek, don't tell anyone, workbook that is coming out around AICPA Engage, June 10th to 12th. It's got a lot of getting started FAQ. So don't confuse this with our software. The software is software. This is an Excel workbook where I've given you the entire ROI method of tax planning. Now, it's manual. So this is going to take you longer than if you uploaded a 1040 into TaxPlanIQ and produced a tax plan in 3 minutes, right? It's not going to have the automatic suggestions, but I want you to know how to do this kind of manual tax planning for, current year client situations, future client situations, and the different phases of planning that you might want to do. So I popped in that 62K of total tax, the 377, and then a state tax rate of 8%. So our client's effective overall tax rate to use for our tax savings estimate is 25%. And let's start planning. So let me hop back over here to my slides. And yes, I'm just going to keep it in this view. So bear with me. Strategy 1, charity. Who does not want to be a part of someone's charitable deductions? Donor advised funds are like a savings account for charity. They get an immediate deduction in the year that they put it in the account at Fidelity or wherever, whatever brokerage fund, and then they can disperse it whenever they want in future years. So there's a concept here called bunching itemization strategies. If someone gets the standard deduction each year, but maybe they're giving a flat $5,000 a year to their church or something like that, and so it's not letting them itemize, we're going to pick one particular tax year that we can bunch a bigger donation or gift into so that they do qualify to itemize that year. And then the following year, they can stick the standard deduction. And then maybe the year after that, you bunch again. This is one of those old tried and true tricks of the trade that can really significantly help your clients, because I hate seeing them give to charity and not get a deduction. All right. So in this case, this client gives $15,000 a year to charity, but it's not exceeding the standard deduction. Maybe they don't have real estate taxes or other things that are going to get them over that 30K threshold in 2025. So what we're recommending, instead of doing $15,000 a year, they told me they sold $2 million worth of stock this year. So they got a little extra cash flow going on, right? I'm going to recommend that they put $50K right away into a donor advised fund. Or maybe they choose to do 10% of the 2 mil as a straight donation. Whatever it is, you take that 50,000 DAF plus, let's say, 12,000 of other itemized deductions. That becomes 62,000 itemized deductions in this tax year. An additional 32,000 that they could itemize above and beyond the standard deduction. And at that 25% effective rate, we've got $8,000 in tax savings that we just poof came out of nowhere with because we're smart, right? So cool. I love the knowledge that we can use to magically and legally produce these savings for our clients. So we maximize that out, and I've added that to my plan. So my very first line item here in the workbook is the donor advised fund, itemized bunching. It's just 1 year only, so I don't mark it for recurring, and it's saving us the 8K. Moving on to the next one. A LIRP, life insurance retirement plan. We have a wonderful vendor, Dave Spence at Tax Free Tutors in TaxPlanIQ. We have a ton of preferred vendors in TaxPlanIQ, by the way. And he will help you figure out exactly how to implement this in your plan. It is a very low-hanging fruit. If someone's already maxed out all their other pre-tax and retirement contribution amounts, this is an after-tax option that still gives them some tax-free income in the future. So let's talk through that. A LIRP is an indexed universal life insurance policy structured to grow cash value that can be accessed tax-free in retirement in the form of loans, okay? And then, of course, you have a death benefit that is tax-free as well after they pass. So the eligibility, you tend to want to be between ages 35 and 65 because you do have to go through the typical life insurance qualifications, blood work, etc. They're already maxing out all their other pre-tax type deductions and retirement plans, and they have, let's say, 15K to up to 40K available for 10 to 15 years that they can pump into this plan. Our client is 55. They decided to go ahead and put $50,000 a year for 10 years. The cash value after year 10 is $580K. They start doing these tax-free withdrawals from age 66 to 80 of $61,440 a year, and they have the death benefit of 1.25 mil. How does that come together? Okay, I'm going to admit I had to use a little bit of help with a calculator on this one because it's a little hard to do just in your brain. We've got the 10 years of 50K contributions that add up to 500K. We then actually get the turnaround of another 15 years of tax-free loans or withdrawals that add up to almost $1 million, 921K later on in life. So that's a remaining death benefit after the loans of about 329K. The total net death benefit is the 1.25. So our net gain over those contributions that we do over the next 10 years is about 750K. So what I did was, instead of having to figure out, well, how do I show the client the taxes they're going to save in 20 years from now? I took that and I amortized it out, so to speak, over the next 10 years. So if they're going to make 750K and I want to show them kind of a 10-year plan year to year as they're contributing that 50K, what they're going to make back, it comes out to about 75K of cash flow back each year, and a savings equivalent of 18,765 at a 25% bracket. So you'll see that's how I actually popped it in here. I got the essential tax-free cash flow back of 75K, recurs annually. We use a 10-year projection as our default, and the 18K of savings each year. Okay, on to strategy number 3. We are almost done, y'all. I hope that this is not getting too technical for you. I hope you're geeking out with me. We've got a backdoor Roth IRA. So this client had $42,000 of taxable IRA distributions this last tax year. If they had done a backdoor Roth over several years in the past, or if we can maybe get them to do that now, then we could avoid the tax on the IRA, right? So if your income exceeds the Roth IRA limit of 228K married filing joint, they have no existing pre-tax IRA balances to avoid pro rata rules, and they use taxable IRA line item to estimate. You can use the taxable IRA line item to estimate the savings if they had done this before. Like the opportunity cost of missing out on this stuff tends to be very eye-opening for your clients. So in this case, we have someone with income of, 300K. They immediately contribute to a non-deductible traditional IRA for $7,000, immediately convert to a Roth. If they had had any earnings on that, they'd have a tiny little tax due, ordinary tax rates on that little converted amount. But a lot of times you can capture that like same day, roll over, and you're good to go. And then your money immediately grows tax free for retirement. You don't have any required minimum distributions, and it boosts your tax diversification. So this isn't for everyone. Some people, it might be too late, but for some clients, you could start this now, do it for the next 10 years, and have a nice little Roth IRA nest egg. On to strategy 4, annual gifting. So going back to what Jennifer Baker was talking about earlier, we have the estate gift limits of about $19,000 per donee. 2 spouses can double that for a person, right? And Trump is proposing a 15 mil estate tax exemption per spouse. So that could be like a 30 mil exemption, right? But we're always on that fence of like, are they going to take that away? If a different administration comes in, that could get halved. So what do you do about these clients that are right there on that threshold, right? We're not sure. And maybe this client's like, yeah, I probably will have a $32 million estate at the end of the day, and I don't want to chance it. Well, start doing annual gifting now. And you can recognize the tax savings of that future benefit now too. So anyone with an almost or taxable estate planning need, we know that the estate tax quickly jumps to like 40%, right? And we do not want to subject our beneficiaries to that stuff. And they want to transfer wealth immediately, not have to worry about it later. So in this example, we're gifting the 38K each to 2 kids. So 76K of a tax-free gift each year without having to file an estate tax return. So you could gift a business interest, you can gift dividends or stock. There's all kinds of stuff you can gift, right? That's not necessarily just cash. And it immediately transfers the wealth to lower income tax brackets that you might be supporting anyways. It avoids the the current gift tax, future estate tax, and builds that legacy, which is pretty cool stuff. So how do I translate that into savings? Well, my backdoor Roth, I took the 42,000 estimate from the 1040 as my like tax savings predictor, just for proposal purposes of estimating about $10,000 of tax savings for the client. That could be 1 year or multi-year. And then our annual gift, I took the 38,000 and I applied a 40% rate. You might want to take this down some just to be extra conservative, because you've got present value discounting, but you also have potential future higher estate tax. And so those two things kind of even out to where you're probably going to end up still saving them 30, 40% of estate tax, but you can use a more conservative amount here if you'd like. And so far we've got 50K of tax savings for this client in this phase of planning. Let's go on to our last strategy, and then we'll wrap up our session. The QSBS Section 1202 exclusion. So we saw in the client's return, they had 200,000 of cap gains. They tell us when we ask, hey, what changed this year compared to last year? Oh, well, I've got this 2 mil of stock sale. Okay, well, let me ask you a few more questions. Does this company qualify as small business stock? Go ask them if you're not sure. It would be gross assets of less than 50 mil. And were you the original acquirer of this stock and held it for at least 5 years? If so, you've got a $10 million capital gain exclusion on the sale of that stock per taxpayer. Now, be careful with that, because some people say that 2 spouses combine into 1. There are ways to stack this strategy. So if you're worried about that and you've got like a $20 million gain, you could do 10 mil recognized at the personal level for both spouses, just in case. then you could actually form like a charitable trust and recognize another 10 mil because it's a separate entity. It gets its whole separate 10 mil thing. So there's ways to structure this from the get-go that can really help you out. So in this case, they purchased 10,000 shares of a startup for $100,000 in 2018. They sold it for 2.5 mil this year. They have a 2.4 mil that gets excluded from cap gains tax. They paid no federal capital gains tax after holding for 5 years, leveraging the 1202 benefit. So that looks like a one-time 2.4 gain at 20% cap gains. That's almost $500,000 in tax savings for this client. So year one, we can save them over $500,000. Year two forward, another 30K. But hey, maybe we'll do another phase of planning then. Here's that CURB calculation that you can do. So we're saying, oh, well, here's our year one savings. What's our complexity, urgency, risk, and tangible benefits? And it's suggesting quite an annual fee, or suggesting quite a one-time implementation fee. Maybe you adjust that a little bit more to your liking, or you decide to cap things at your firm. Maybe you won't take clients that you can't charge at least $5,000 tax planning fee, but maybe the strategies you use, you cap that fee at 50K. That's up to you, right? But it's suggesting a pretty substantial fee here. You could also plug in the year two forward savings and then do a monthly fee from there. And then what the AICPA and us at TaxPlanIQ have been working on is this very simplified proposal to help people move to tax advisory. Because if you can sell one plan like this, you're going to want to start doing all your plans like this, right? And then start automating it with tech and tools from there. There's also monthly package options that we're giving you here. You can go to jackie.cpa/packages if you'd like to see exactly the 3 different tiered package levels that we offered at Meyer Tax as well. And on that note, I've got one more slide. We'll take a real quick break and then we'll go on to our next session. But big announcement is at AICPA Engage, the Wednesday night during the reception, there will be a tech demo that I'm giving with the AICPA where we will mass release this workbook and ROI pricing methodology for the profession. It's a complete gift to the profession. I'm so freaking excited about this because it's going to help so many people move to value pricing, move to advisory. By the way, you don't have to use the ROI method just for tax advisory, right? And come to my tech demo if you're coming to Engage. We're also hosting a cabana party on Tuesday around lunchtime. So keep in touch. Would love to see you there. I hope this session was helpful to y'all and you got some really cool ideas. And on that note, let's take a 1-minute break and then we'll circle back.